If Taiwan becomes a live market crisis, the first question is not whether the headline is scary, it is whether portfolios are built for the speed of the shock. So today, no slide deck voice, we are going to argue it out. What breaks first? Chips, currencies, credit, or investor nerve?
The thing that worries me is speed. Markets know Taiwan matters, but they still behave as if escalation will arrive politely, in stages.
I think that overstates the surprise. Investors have talked about Taiwan risk for years. Some of that fear is already sitting in semiconductor multiples.
Wei, that is a market answer. It is not a supply chain answer. If advanced foundry capacity is interrupted, you cannot buy your way around physics in 2 weeks.
I am not saying there is no shock. I am saying the first trade may be hedging, and the second trade may be buying what everyone just sold.
That is exactly why the response cannot be emotional. You hedge before certainty. Then you keep liquidity for the repricing. Those are different jobs.
The currency channel is where this gets fast. Taiwan dollar first, offshore yuan next. Then Korea and Singapore get pulled into the same conversation.
So not global panic everywhere at once, but an Asian stress wave.
Exactly. It starts as regional pressure. Then credit spreads widen where China trade exposure is heavy. Indonesia and Vietnam are not the epicenter, but they are not insulated either.
And we should not treat the strait as a single point on a map. Once shipping insurance starts repricing, Malacca risk can turn a technology shock into an energy conversation.
The market keeps saying 60 to 90 days of inventory, like that is comfort. It is not comfort. It is a countdown clock.
But Lisa, if the market knows that clock exists, why assume it is mispriced? Tail risk is not invisible anymore.
Because knowing something and being able to replace it are different. You can reprice a stock in seconds. You cannot rebuild advanced packaging capacity in a quarter. This is where I land. Reduce concentrated Taiwan exposure. Hedge Taiwan and Korea downside. Hold some gold and keep cash ready. Not because we know the path, because we do not.
That is a fair distinction. My issue is when a hedge becomes a forecast. If everyone is already terrified, the best risk-adjusted move can flip faster than people expect.
Then we watch the evidence. Sustained PLA exercise tempo, shipping insurance, capital control signals, CNH option skew. Those are not vibes. Those are signals.
I would add central bank behavior. If the PBOC is leaning hard against CNH pressure, that tells you the stress is moving from headline risk into financial plumbing.
So the real disagreement is not whether Taiwan matters. It is whether the market reaction is too small before the shock or too large after it.
Yes, and that is the useful tension. Protect the left tail without becoming paralyzed by it.
For me, semiconductors are the primary channel. If that channel breaks, everything else reacts around it.
For me, the descent is sizing. The first drawdown could be brutal, but the recovery trade may start while the headlines still sound terrible.
For me, the danger is assuming there will be time. Escalation risk is usually boring, until suddenly it is not.
Oakhampton's practical view is this. Treat Taiwan as a portfolio design problem, not a prediction contest. Hedge what can hurt you, keep room to act, and demand evidence before conviction. References are at the end of the description. The Oakhampton scenario note and the source families discussed in the analysis. This is information only, not investment advice.